Did you know that financial landlords are leading the charge in raising rent prices in Toronto? According to a recent study by the University of Waterloo, these landlords are increasing rents far more aggressively than other types of landlords, impacting housing affordability significantly. Welcome to the Multifamily Real Estate Insights podcast. I am your host, Sandy McKay. Let's get right to it. The study, conducted by the University of Waterloo, reveals that financial landlords, such as private equity firms, real estate investment trusts, and asset managers, are the largest acquirers of rental properties in Toronto over the past 2 decades. These corporations use rental properties to generate returns for their investors, and as a result, they are leading the industry in raising rents and worsening housing affordability in the city. According to researcher Martine August, a professor at Waterloo's Faculty of Environment, financial firms acquiring a growing proportion of Toronto's multifamily housing stock are systematically making it less affordable by raising rents to increase revenues for their investors. On average, asking rents among financial landlords are 44% higher than the average rent paid in Toronto neighborhoods. The study highlights that while it is expected for asking rents to be higher than average rents, especially in neighborhoods with rent-controlled units, the gap is notably wider for financial landlords. Chain and chain-managed landlords charge 30% more than average rents, landlords owning a single property charge 22% more, and those with multiple properties charge 15% more. Interestingly, nonprofit landlords charge about 1% less than average rents. The findings also indicate that financial firms have been raising rent prices faster than any other type of landlord. The disparity between average rents and asking rents charged by financial firms is most pronounced in low-income, racialized communities. Financial landlords raised rents by 5.03% per quarter, compared to chains at 4.99%, chain-managed buildings at 3.75%, landlords with multiple properties at 4.83%, and single-property landlords at 3.61%. Nonprofit landlords raised rents by only 1% per quarter. The report notes that marginalized neighborhoods, particularly those designated as neighborhood improvement areas by the City of Toronto, are hardest hit. In these areas, rent prices for units owned by financial landlords are 49% more than the average rent price in the neighborhood. This supports the long-standing theory among researchers and activists that financial landlords are the worst offenders for rising rents and diminishing affordability. Professor August suggests that the external pressure to deliver returns to investors makes financial landlords more aggressive in their rent increases. She notes that these landlords often boast about charging the highest rents and raising prices to maximize shareholder profits. The study is the first to examine building-level rent data and track changes over time, supporting policy recommendations to rein in financial firms through regulating rental housing, expanding tenant protections, and promoting social housing over for-profit ownership. August argues that financial landlords should not be able to access government support through Canada Mortgage and Housing Corporation programs and Canada's National Housing Strategy. She questions why subsidies are provided to companies whose business strategies make housing unaffordable, suggesting that government support should ensure firms are not violating the right to housing by reducing security of tenure and worsening affordability. In a significant development in the multifamily real estate sector, Mesirow Financial has successfully closed a new multifamily fund with an impressive $1.245 billion raised. This is a substantial increase, about 66% more than their previous investment vehicle. The news was announced by Mesirow Institutional Real Estate Direct, emphasizing the growing confidence and support from their investors, with over 70% of the capital coming from repeat clients. Alastair Cripps, CEO of Mesirow Institutional Real Estate Direct, expressed his gratitude for the continued support from investors as they expand their platform of value-added, risk-balanced multifamily real estate strategies. The fund, known as Real Estate Value Fund 5, is set to target value-add multifamily assets across the top 30 United States markets. The focus will be on properties with potential for revenue growth through cost optimization, space upgrades, and shifts in property management. The fund's strategy includes adding amenities such as golf simulators and co-working spaces, along with updates to fittings and fixtures. This approach aims to reposition underperforming Class A multifamily assets, acquired at discounts, in high-growth markets where barriers to entry can mitigate the risk of oversupply. Interestingly, Mesirow has already deployed roughly a quarter of the fund's capital across 6 acquisitions, including the Preserve at Melrose in San Diego. It's worth noting that less than 10% of the fund's capital will be deployed in Midwest markets, indicating a strategic focus on coastal areas. This aligns with the broader trend of multifamily investors eyeing apartment buildings as profitable ventures, especially in the wake of the pandemic when rents soared. While there's been some unease about a construction boom impacting rent growth, the market has largely absorbed new deliveries, excluding a few exceptions like Austin. According to a survey by Berkadia, over 80% of multifamily investors were looking to acquire assets in 2025, reflecting a growing optimism in the sector. This sentiment is encouraging for investors and developers alike, as it signals a promising future for multifamily real estate investments. In recent news from St. Charles County, a city has decided to impose a moratorium on future multifamily developments. This decision comes as part of an ongoing effort to evaluate and manage the growth and impact of multifamily housing in the area. According to the St. Louis Business Journal, this moratorium will temporarily halt new multifamily projects, allowing city officials to reassess zoning laws and infrastructure needs. The city officials cited concerns over the rapid pace of multifamily development and its implications on local resources, traffic, and community character. They believe that a pause in development will provide the necessary time to conduct comprehensive studies and engage with residents to ensure that future developments align with the city's long-term vision and capacity. It's not uncommon for cities to implement such measures, especially in rapidly growing areas where the demand for housing is high. These moratoriums can be seen as a proactive approach to sustainable urban planning, ensuring that growth does not outpace the city's ability to provide essential services and maintain quality of life for its residents. While some developers might view this as a setback, it could ultimately lead to more thoughtful and strategic planning, benefiting the community and investors in the long run. This period could also be an opportunity for developers to engage with city officials and residents to create projects that meet the needs of the community while also being economically viable. As cities continue to navigate the challenges of urban growth and housing demand, it's crucial for stakeholders to collaborate and find balanced solutions that support economic development and enhance the community's well-being. This moratorium in St. Charles County may serve as a model for other regions facing similar pressures from multifamily developments. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy McKay. See you on the next one.